Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. The International Energy Agency has agreed to release 400 million barrels of reserves. The move is the largest ever release of emergency oil as governments seek to contain a spike in energy prices driven by the Middle East war. The agency says current oil market challenges are unprecedented. MDA Space is looking to raise $300 million U.S. in an initial public offering in the U.S. last month. The CEO of the satellite company told Bloomberg a subsidiary in the U.S. or Europe would help the company become a government contractor in those jurisdictions. The Brampton-based company did not disclose how many shares it would offer or the price per share. Shares of CES Energy are getting a boost after reporting higher profit and revenue in its latest quarter, beating estimates. Now, revenue growth also increased in Canada and the U.S. CES has boosted its dividend and says looking ahead, it expects resilient supply demand as well as steady drilling and production activity. It's up about 3.25%. And looking to the markets right now, the up and down day continues. The TSX clawing back some losses right now. It's off by about 0.39. Tech taking the biggest hit, materials as well. Both of them are off. Tech is off by 1.95%, materials by 1.78%. South of the border, mixed bag there as well. They have been up and down all day. S&P 500 off by 0.12, the Dow by 0.68, and the Nasdaq's off by about 0.1. Well, U.S. inflation slowed in February, with prices rising 0.3% from a month earlier, in line with estimates. While inflation in the U.S. has been on a downward trend in recent months, the conflict in the Middle East has renewed concerns. Here to talk more about that is Keith Buchanan, Senior Portfolio Manager at Globalt Investments. Keith, thanks very much for joining us.
Thanks for having me.
Today's inflation, can we do anything with it, or is it really we're now waiting to see what happens over the next month?
We're now in somewhat of a wait-and-see mode as the pressure on inflation and the cause of that pressure have obviously shifted to more geopolitical concerns with the war in Iran and the major feedstock of the world's cost has been in flux, and the volatility of oil and energy prices has really changed the dynamics of what we're looking towards as far as the inflationary pressures going into the latter half of this year. So another report will probably encompass some of the most recent changes over the past 10 days as corporations have priced some of this new dynamic into how they really push their products and services. So we still have a while to see some of that feed through to the system.
What might be the biggest concern with obviously the fact there's war major ag on, but are there other concerns that could even make this even worse?
Sure. Of course, as this conflict continues to wear on, we're having to come to grips with how that will feed through to the macroeconomic picture, and specifically about the data that was in the report this morning, how that would shift over the next month. We're looking for transportation costs to perhaps bake in some of that inflation as well as airfares. We've seen that really dominate some of the prints that we've seen from CPI over the past couple of quarters. So this last report really, both of those dynamics were subdued in a way that led to a number that was within reason of where we should be and where the market expects this inflationary picture to be headed, especially to justify a monetary policy that continues to ease as we get into the latter half of the year. So there are a lot of moving parts. Transportation costs, airfares are some of the largest that we're looking to really encompass some of the changes that we've seen from a geopolitical standpoint over the last 11 days.
And the Fed does really have a fine line to walk right now with everything that's unfolding. I know where they were talking about possibly 2 rate cuts, but do you feel that's realistic at this moment, depending on, I guess it's all depends, isn't it?
It does all depend. We've seen market expectations move away from 2 being the certainty, or at least 2 being the certainty for 2026, and pricing in more of a possible second cut in the latter half of this year. As inflationary expectations and that pressure from very volatile energy costs really feeds through to not only the supply chains of U.S. Productivity as well, but also into the psyche of investors as the market has anticipated a more dovish Fed coming into 2026. For some time now, as we approach this soft landing time period, the soft landing becomes more of a question. If we have expectations that inflationary pressure could persist longer than the market originally expected. So it's something really to watch coming into the next couple of quarters here in 2026.
And so with all this, where are you looking right now? We've seen some rotation out of tech. Where are you looking? Where do you see opportunities with everything that's unfolding? There's so much volatility.
We feel like the ultimate opportunity it has been what's really been punishing investors for the last couple of years, which is diversification. Being broadly diversified from a global and market cap and style standpoint really hasn't benefited investors in a material way, as so much growth has been concentrated and frankly, asset price movement has been concentrated in the large cap growth, U.S.-centric parts of the marketplace. We've seen that start to spread out some with going down to small cap is also value cohorts have done better, and international has done really well over the last couple of, call it better, year and a half or so. So we're looking, and diversification has always been kind of a stalwart of our process, and we're looking to remain diversified and more balanced going into this next quarter as some of these geopolitical concerns, fiscal concerns, monetary policy starts to really take shape in the latter half of this year. We think it benefits investors to be more diversified than what perhaps benefited investors over the last 2 years.
And when you're looking overseas, Japan obviously is a big concern with the oil, depending on how long this goes. Are you worried about Japan, or are you looking at Europe?
Sure. Developed markets are definitely part of our strategies here and going forward. We feel like being more broad is probably the best approach right now, given so much is in flux with how some of the geopolitical concerns can develop over the next couple of weeks and even quarters. So we're not necessarily picking countries right now. We want to make sure we have some dry powder to put to work as in a broad way as we look at the world from a construct of monetary policy, fiscal concerns, as well as potential economic growth, and how those might shift given what's going on in Iran and also in Europe as well. So there's just a lot in flux right now, and we're making sure that we have some capacity to take advantage of opportunities as some of the smoke starts to clear, when it does in the weeks down the road.
And the small caps, any worry that with everything that's unfolding, they might feel the effects the most?
Right. We feel like the valuation gap that narrowed a bit between large cap and small cap really still persists on a historical standpoint. The wider your aperture, the more the gap still persists. Historically, that doesn't last for very long. You can see very quick and sharp outperformance in small cap versus large cap. We start to see some of that. We don't necessarily know if that's complete right now, particularly with some of the challenges to the AI names, also AI adjacent names, and what damage that could do to software spaces and other spaces that we've started to see trail the market here over the last couple of weeks. So we're really interested in that dynamic continuing to close between large and small cap, and we remain positioned to take advantage of that.
Okay, we have to wrap it up there, but Keith, thanks very much for joining us.
Thank you.
Keith Buchanan is Senior Portfolio Manager at Globalt Investments. Oracle shares are surging today on its third quarter earnings beat and future guidance. We'll have more on that after the break. Oracle is soaring after it beat third quarter earnings estimates and raised its revenue guidance. This still puts the stock around 15% in the red for the year, 16% right now. It's lost a little more today, but my next guest sees a path for Oracle to rebound with revenue increasingly shifting towards cloud. Let's hear from Rob Oliver now, Senior Research Analyst at Baird. Rob, thanks very much for joining us.
Great. Good afternoon. Thanks for having me.
What do you like about this this earnings report? What's standing out for you?
Well, I think, first of all, the setup into the earnings report was pretty good. I mean, expectations for Oracle were pretty modest. As you said, the stock had underperformed, and in fact, it had pulled back all the way to flat in the trailing 12 months, was trading directly in line with the IGV software index in terms of performance. So all of the AI hype was out of the stock. Still, there was a concern that the company was going to have to raise CapEx. And that's really the main thing. Our view coming into the quarter was, you had some positive things to hang your hat on here with Oracle. One was Oracle's main customer for infrastructure is OpenAI, and OpenAI secured a $110 billion funding deal during the quarter. 60% of Oracle's backlog or RPO is associated with that. That plus Oracle's funding and financing itself, which they announced during the quarter, sort of provided some better comfort and setup. So I think the stock reaction you're seeing today is partly some short covering on rising short interest, but also some investors, I think, revisiting now for the longer term story, which is around their ability to manage costs around this very complicated build out, but also the longer term story, which I hope we can talk about, which is about why Oracle's so well positioned here for AI.
Well, let's hear it. Well, let's talk about it right now then.
Yeah, so I think if you go back a decade or so, we saw a lot of the big companies that were not infrastructure as a service native players really become infrastructure players, like Amazon became Amazon Web Services, Google had Google Cloud Platform, and of course Microsoft had Azure. And each of those businesses had other businesses upon which they used as a foundation to kind of build out those services. And now, we sort of take it for granted those are out there. Oracle's attempting to do something similar here in their pivot to become an infrastructure provider at a pace that's really unprecedented. But importantly, that is on top of what we think is one of the most important kernels around what's going to drive AI, which is two things, which is data, and Oracle is the #1 provider of enterprise databases globally, and then outcomes or inference, which is where Oracle has had a strong position for many, many years. In fact, that's really going back a few decades now in terms of how to turn that data into applications and outcomes. So we think because of that, Oracle sits at a pretty advantageous position relative to where AI is going. And in fact, you heard them call that out last night. I thought it was good that they addressed it. The CEO talked about the death of SaaS trade and some of the concerns on software. Your previous guest talked about that. It's obviously a really big topic. It's certainly a very important topic in my world because I follow software. And I think there are some very legitimate, concerns when you have these massive tectonic shifts in technology. But what Oracle said last night was that platform players with data that are solving real problems for people, such as they're seeking to solve with OCI, are going to be fine and will not be disintermediated by AI. And they said, hey, death of SaaS might apply to some companies, but it won't apply to us. So overall, we heard some really good messaging, some crisp messaging around the finances, around the numbers, around the plan, as well as an overall beat and raise. And then I think really good indicators about the future of AI for Oracle last night.
You got to admire Ellison when he calls a company the size of Oracle a disruptor. That's ambitious for a company. He says his company can move and pivot now, doesn't he?
Yeah, it's pretty amazing. I mean, let's go back to the example of the companies that I call out. I mean, I don't have the chart in front of me right now, but Microsoft was flat for a better part of a decade, right? I mean, under Steve Ballmer, many had written it off, and Satya Nadella came into Microsoft and turned that business around with a totally different perspective. And at the risk of oversimplifying, I would say that we're in a position right now where some of these, there's going to be every tectonic shift within technology, and I've now lived through a few going back to the 90s, has newcomers that are going to come in. So there are going to be new companies that are coming in to disrupt, and we're already seeing that. They're being well funded, and some of them are going to make it out, and some will even become household names. But there also are companies that are able to, because of scale, presence, and most importantly, a culture of innovation, reinvent themselves at important times. And I would say Oracle has really grabbed onto that third when many thought they would not be able to do it. And they're really latching that onto that OCI infrastructure, which they see as a vehicle, I think, to not just deliver the infrastructure for AI, but also to deliver the full AI experience, which goes back to what I was saying earlier around data and outcomes.
And I know Larry Ellison, I mean, I don't think he's day-to-day so much, but he's still the executive chair and technology chief. Any concerns with him with the Paramount deal and his role in that, if that's going to take him away from Oracle?
Yeah, good question. I know it's his son who's involved with that. I know he's made some comments about it as well. We have gotten questions from investors on it. I'm not a media expert by any means, so we don't have an official view on that. To the extent in which it starts to, if it becomes an issue relative to, Oracle or Larry's stock holdings, then we would need to investigate more. But no, I mean, I think at this point, obviously there's a lot going on. Oracle's a company it's complex. There's a lot of stuff going on in the business. But what I would say is that these guys are executing now on a master plan, and it's a complicated one, to take a company that is historically really an asset-light software company and moving it to become an asset-intensive infrastructure business. That is not easy. And they're doing that right now. And I think last night's quarter certainly indicated that they are on good footing early on. They even provided some updated comments relative to gross margin on their infrastructure business, which was positive. It was over 30%, and I think viewed positively by the street. Another source of concern: are they losing money on these deals? They're not, and they've insisted they won't.
Okay, we have to wrap it up there, Rob, but thanks very much for joining us.
Great. Thanks for having me.
Rob Oliver is Senior Research Analyst at Baird. Well, the International Energy Agency has agreed to release a record amount of emergency oil. We'll talk about what that means for oil prices after the break. The International Energy Agency is agreeing to release 400 million barrels of oil to address the supply disruption caused by the war in Iran. This is the largest release of emergency stockpiles in the history of the agency. Here to talk more about how this could impact oil prices is Jason Gableman, Managing Director of Equity Research at TD Securities. Jason, thanks very much for joining us.
Thanks for having me.
All right. This is about 16 days, I think, of oil for the world. What kind of an impact will this have?
Certainly we saw oil prices move yesterday lower on the potential for this release, which was announced today, 400 million barrels. But at the end of the day, you can't get enough of this crude out in a fast enough pace to offset the amount of crude that the market has lost because the Strait of Hormuz has been closed. 15 million barrels a day of crude flows through the Strait prior to this conflict. We think Middle East will ultimately be able to reroute 5 million barrels a day. So the market is still short 10 million barrels a day. And while the 400 million barrel release is significant, it's not going to be able to be exported from the reserves themselves at a fast enough pace to offset that 10 million barrel a day loss.
So where does that leave us? Will we see another release? Can they do another release like they did in 22?
I think they'll take some time to see how the market absorbs this additional supply being added to the market. They certainly could do another release, but every time you do a release, especially of this size, you of course lose a very important buffer for the market. The other element is what the U.S. administration is signaling about this conflict. They have suggested the war will last a matter of weeks. So I think the IEA and the G7 countries will probably wait to allow that time to pass before they evaluate if another release is required.
And this release, does it restore some confidence for investors, or does it make them more nervous, do you think?
I honestly don't think it really does much of anything for investors. Like I said, it's not enough to offset the disruption that the market is seeing. And for the amount of time this conflict goes on, we think oil prices are going to continue to move higher, with or without the SBR. Clearly, more supply in the market is going to result in some near-term oil price response to the downside. But whether that is sustained is ultimately going to be dependent on the duration of the conflict more than anything else.
And countries around the world, the U.S., Japan, Europe, who can weather this the best? Which country do you think can weather this the best right now? The situation?
Yeah, it's of course the ones that are least dependent on not only Middle East flows directly, but imports as a whole. The global crude market is, of course, globally connected. So are petroleum product markets as well. So countries that are less dependent on oil imports and other commodities that have been disrupted, such as gas for that matter, are going to be able to weather the storm the best. North America is less energy dependent on imports than other parts of the world. Asia is the most dependent on imports. So North America should be able to weather this conflict from an energy price standpoint better than Asian economies.
And if this drags on and it's not over in a couple of weeks, when might we see, like places like Japan, could we see restrictions or anything like that come into effect?
Yeah, we've already seen export restrictions in places such as China and smaller Southeast Asian countries. That's certainly something those countries that have the ability to restrict exports will evaluate. Other things like tax holidays on fuel and other reforms could be put in place. Every day the oil price moves higher, we think the government is certainly taking a close look at things and trying to determine how they can minimize the shock to the consumer. But there's only so many effective tools in their toolkit that they could deploy.
And I mean, the other thing, no matter when this ends, there's been damage. There may be more damage to the infrastructure itself. How much of a factor is that in the Middle East?
Yeah, so right now it appears the damage has been pretty limited based on our channel checks. There have certainly been assets that have been shut down because the tanks are getting full and you can't export crude or products out of the region. But in these types of controlled shutdowns, the damage tends to be pretty mild. We've only read one large refinery is currently down. LNG facilities have been shut down. There have been attempted attacks. But it doesn't appear like there's damage, and same to most oil fields. It will take time to ramp up these assets once the Strait of Hormuz is reopened and the conflict ends, and that could be measured in weeks to even a month. But we suspect that most of the assets should come back to where they were prior to the conflict once the conflict ends.
And are there, I mean, and if these, do we know how many ships are actually kind of trapped at the Strait of Hormuz and can't get out? They're loaded. And once it clears or they get the ability to get through, they still have to get through and then they have to get back. How long will it take to kind of rebuild the supply line from that aspect?
Yeah, so we see about 50 million barrels of crude that have built up inside the strait as a result of this conflict, and it'll take a few weeks for that to get to market. But the conflict's been going on for 12, 13 days. You're losing 10 million barrels a day. So you're talking about over 100 million barrels. The amount of crude that's built up so far on the water won't be enough to offset that. You're going to need to see higher flows out of the region for a sustained period of time in order to rebuild inventories, which could take a few months, a quarter, or even longer, depending on how long the conflict lasts.
Okay, Jason, thanks very much for joining us.
Thanks for having me.
Jason Gebelman is Managing Director of Equity Research at TD Securities. After the break, we'll continue our coverage of the oil markets and bring you today's TSX trending trades. Stay with us. Canada is urgently exploring options with provinces and the energy industry to boost oil supply. This, according to a spokesperson for Energy Minister Tim Hodgson. The trade disruptions, of course, caused by the war in the Middle East, has seen oil prices surge, and so Canada is looking at ways to increase output and adjust transportation if supply routes need to be changed. Shares of Ballard Power are seeing a surge. The fuel cell maker has reached an agreement to provide 500 fuel cell engines to New Flyer, a subsidiary of NF Group. The deal is the largest order in Ballard's partnership, and the engines could generate up to $50 million of revenue. Delivery is expected to start later this year. RBC has acquired Toronto-based Pinch Financial as a mortgage qualification platform. Pinch verifies borrower information and online to help Canadians submit applications to lenders. The bank says Pinch's technology will accelerate its digital roadmap to deliver a quicker and more streamlined mortgage experience for Canadians. The terms of the deal have not been disclosed. And taking a look at the markets, the TSX in the red right now, off by about a half a point. South of the border, it's been an up and down day depending on when you take a look. And right now, the American markets are, where are they at? There we go. Still mixed day. You can see the S&P 500 barely off. It's a wash pretty much. Dow, though, off by 0.6 nearly. And the NASDAQ is up by 0.11. G7 nations and IEA member countries will organize the discharge of a maximum of 400 million barrels from the emergency oil reserves over the coming days, according to French President Emmanuel Macron. For more on this, we're joined by Bloomberg's Simon Casey. Simon, thanks very much for joining us. I guess the question everybody wants an answer to is 400 million enough?
Well, it's a lot of oil for sure, and it's a record amount, as you say. It's more than double the amount that was earmarked for release back in 2022 when Russia invaded Ukraine. But we face a very big challenge with the Strait of Hormuz, essentially impassable to tankers right now. Something in the region of 20% of the world's oil typically flows through the strait when it's open. Placing all of that is a big challenge. Now, some of that supply can come out through pipelines across Saudi Arabia and other parts of the Middle East, but it's a big supply gap to fill. Now, if you do some basic math and you work out 400 million barrels and 20 million barrels may be missing from the market, say that's about 20 days supply, we could be looking at maybe even a month's supply here, which it's a lot of oil, to be clear. But if the situation as it stands, if it drags on for several weeks, they may need more.
Mm-hmm. I was going to say, have they talked about that they may do a second release like they did in 22?
It's far too early. I mean, we're still waiting some of the details. We haven't actually had a full confirmation from the U.S. side that the Strategic Petroleum Reserve here in the United States will play a part in this. That's the assumption. It would be a major surprise if there were sort of last-minute reservations. The U.S. has in effect agreed to this, but we are waiting the details on still how this release will unfold, at what level, at what pace the oil will be dispersed into the markets. It's far too soon to talk about other releases, but there are other options on the table. And we know that in the White House, there have been deliberations in recent days about possible tax holidays on gasoline sales and other options.
And that's, I imagine that conversation, would you like to be a fly on the wall for that with the election coming up and everything else that is unfolding? We saw inflation come out today. Has it been kind of floated publicly, that one, or have we heard anything?
No, this is based on our reporting, our exclusive reporting. None of this has been. Today was actually the first time we've heard from Doug Burgum earlier today, the Interior Secretary, about acknowledging that the stockpile releases are a real thing. Otherwise, these deliberations have been very private. As you say, this is a major political consideration for the White House right now. The November midterms could well be decided in large part on the affordability question. We're seeing rising electricity prices here in the US. Trump has made a big stand on his on having gasoline prices low until now during his presidency in comparison to Biden's presidency. It would be very difficult for him if gasoline prices remain elevated where they are now.
And have we heard of any other countries offering something similar or doing something similar?
Not yet, no. But it's a global problem, as you're suggesting, and it's particularly acute in Asia, for example. Many major Asian economies are almost wholly dependent on gasoline and crude oil imports. This is a global problem, to be clear. And now, depending on some countries, subsidize fuel sales more than others, but to be clear, this is a problem that all the major economies are having to deal with in their own way.
Okay, lots more to talk about on this, but we've got to wrap things up for now. Simon, thanks as always for joining us. Bloomberg's Simon Casey. And off to China we go now. Its next 5-year planning cycle. It's entering that, and Beijing is intensifying efforts to rebalance the economy toward domestic consumption. Bloomberg's Stephen Engel reports on the rise of destination outlet malls and the role of AI in the services sector as China's leadership targets a 4.5% growth rate against a volatile global landscape.
China got a record bump in Lunar New Year holiday spending this year, but that's seasonal, not necessarily sustainable. Hence, Beijing's top priority in the next 5-year plan through 2030 is to boost domestic demand. Sure, we've heard such calls for rebalancing before, but with rising uncertainties abroad and excess industrial capacity and falling prices at home, Beijing is, well, banging the domestic consumption drum harder than ever. An hour's drive from central Beijing and the seat of power sits the largest outlet mall in northern China. Opened in December, the sprawling Wanli commercial and entertainment complex is a gigantic bet that physical retail is not dead. Like many things in China, this place is absolutely huge. It's 5 million square feet of outlets and leisure space spread over a suburban footprint equal to 64 American football fields. Sure, there are the usual Western brands, but also many homegrown names most outside of China have never heard of, as Beijing further pivots from its made-for-export model. Where traditional malls are seeing rising vacancies, discount destination outlet malls are springing up nationwide. President Xi says China must fully leverage the advantages of China's, quote, super large-scale market, aided by sizable investments in AI, to boost the sale of goods and services.
I think one of the challenges of boosting consumption as GDP is Chinese are never going to spend like Americans or Europeans, so we don't quite know what the numbers should be. I think, to your point, AI will boost also the service sector. That's really the game changer.
Still, there are significant hurdles to overcome. Authorities, for one, are ordering an end to price wars in everything from EVs to food delivery, a deflationary spiral that's hurt corporate profitability and therefore employment, and therefore household consumer confidence that's already been sapped by a years-long property crisis.
If you look at the experiences of other East Asian economies, successful ones like Japan, consumption share of GDP increased over a very long period, like 3 to 4 decades. So we shouldn't expect that the consumption problem will go away immediately. This is why the government needs to focus more on income and the confidence of the households.
No wonder leaders are targeting GDP growth this year of as low as 4.5%.
There's so much chaos in the world. We have wars in multiple places. The U.S. is a bit unstable politically. China just wants to make sure that it can continue to maintain growth.
Especially with what we are seeing at this moment, perhaps the most unwelcome form of reflation, soaring global oil and gas prices. Stephen Engel, Bloomberg News, Beijing.
All right, let's take a look at what's trending today. I was just taking a peek at it right now. First up, we'll take a look at some of the TSX leaders on an off day. Bitfarms is up right now, and they are on their leadership team. They're expanding it to support HPC and AI infrastructure. And coming up next, we want to take a look at CES Energy Solutions, and they're rising after their fourth quarter beat. They rose Wednesday after the company reported higher profit and revenue in the third quarter and said it would raise its dividend by nearly 30%. Shares trading 4.1%. What are they at now? 3.26% right now is where they're at. It reported a 10% increase overall in revenue, beating the expectation of analysts by a about 6%, 7%. And moving on, next up, CES Energy also doing well. They're on their same, on that. Sorry, where are we at here? Hang on, I got myself spun around here. Next up, Parex Resources. There's so many going on right now, can't keep track. They are, what are they doing right now? They're up 4.75%. They are going to buy Frontera Energy's Colombian E&P assets for upfront cash consideration of $500 million, $25 million contingent payment, and we'll assume $225 million in debt. Next up, we're going to take a look at Transcontinental, and they announced their results for the first quarter, and good numbers there as well. Revenue's up, and revenue's up $263.5 million for the quarter. Ending on January 25th, the operating earnings were $8.2 million, and the net loss was $0.2 million. And so right now they're up 1.5%. And taking a look, moving on here, and the laggards now, well, Go Easy. Oh boy, Go Easy is not having a good couple of days. It's down another 19% after losing 60% yesterday. Was that what it was off by? All based on its getting all kinds of downgrades now after they withdrew their financial outlook. They suspended their dividend and disclosed that they had hundreds of millions of dollars in loan losses, and it was likely going to be another challenging year as well. Moving on, Discovery Silver. And they are off right now by about 7.5%. And Constellation Software is one we want to take a look at as well. And BMO lowering the software price target to 4,200, keeps it as an outperform. Right now it's off by about 6.2%. And up next, hot picks in energy, oil, and natural gas. Prices have been on a roller coaster, of course, since the start of the war in Iran, but we'll cut through the noise and look at the top companies in the industry. That's next. And time now for hot picks. Earlier, we zeroed in on 3 plays in energy with Rob Thummel, Senior Portfolio Manager at Tortoise Capital. And we kicked things off with Cheniere Energy as his top pick, a play he says will benefit from the conflict in the Middle East as prices for European LNG continue to rise.
If you looked at what international natural gas prices have done since the war, they've gone up tremendously, and U.S. natural gas prices have not. So there's an opportunity, I think, that we'll see a growth in the demand for U.S. LNG, liquefied natural gas, to be exported to countries throughout the world, whether it's Europe, Asia, or South America as well. And so there's some growth potential there, we think, for Cheniere. Cheniere is already the largest exporter of LNG in the U.S., one of the largest exporters of LNG in the world. And as you know, the U.S. is the largest LNG exporter in the world as well.
Yeah, and I mean, Qatar frustrated for years. They said, we're a reliable, stable supplier, but now they've had to shut down some production or exports.
They have, and it doesn't come back, as you know, to turn these LNG facilities on and off is not easy to do. It takes time, and so there will be opportunities for Cheniere to pick up some extra cash flow while Qatar's waiting to come back online.
Your next idea, EQT, and of course that is a huge player in the shale in natural gas.
Yeah, we like EQT at Tortoise just because we think that natural gas in and of itself has got a huge potential going forward. Natural gas is becoming is starting to be recognized as a really important commodity, especially as electricity becomes the new oil, and natural gas is the largest supplier of, or largest fuel source to generate that new electricity. And so EQT is one of the largest producers of natural gas in the U.S.
I wonder what could go wrong here. I guess a surplus of natural gas. I mean, America has been producing so much. Maybe we could put up a 5-year chart for natural gas itself. There is a risk, I guess, that too much, a glut of natural gas will develop.
Always is a risk of that, Andy, and you're right, and that just would result in the price coming down, and that wouldn't necessarily be as good for EQT in the short term. And what I would say about that, though, is I'm not looking at EQT for the next month or two or week or two. I'm looking at it over the next, obviously 6 to 12 months and then beyond that, because of the role that natural gas is going to play and just the demand for natural gas and how much it's going to go up really over the next couple decades.
And then finally, good old Exxon. You see upside here.
Well, Exxon, if you want to capture what's been going on in the energy markets right now, obviously refining margins are higher, oil prices are higher, natural gas prices are higher. Exxon encapsulates all of that in one individual stock, and so I think that I should preface this: nobody wins in war, and we're not trying to pick stocks here at Tortoise that just benefit from what's going on with the rising tensions in the Middle East. Exxon will benefit from the higher commodity prices in the near term. But longer term, the U.S. is going to need to play a more critical role, I think, globally in providing the world more energy, and Exxon will be one of the companies that does that.
It is interesting. We talked to somebody yesterday, a defense analyst, who said that America, of course, has lots of its own oil, is a major exporter, but still uses a lot of oil. And global oil prices, unlike natural gas prices, tend to rise in sync. Natural gas is still trapped to some extent in North America. So it's a threat to the U.S. economy if oil gets more expensive.
Absolutely. No, you're absolutely correct. That's why we'd like to see, ships start moving out of the Strait of Hormuz, so we can see oil prices come down. Oil is not only just a threat to the U.S. economy; it's a threat to the global economy, right? If oil prices get too high, so I think it's important that oil prices come down to more reasonable levels, so that the global economy can keep growing and the U.S. economy can keep growing. Hey, thanks. Fortunately, we have Canada, Andy, to have that oil keep flowing to the U.S. as well, and that's beneficial as well.
Oh, yeah, that's right. 4 million barrels a day or so. Yeah, that's right. Maybe we could put up a one-year comparative for Exxon and the S&P 500, because my numbers are showing that Exxon is up about 40% in the past year, and that's twice the gain in the S&P 500.
Yeah, I think, I think investors have decided in the S&P 500 is, a lot of investors were invested in mega cap tech, and then they started looking at, where are they underallocated to? Where haven't they invested in? And energy is a place where they hadn't invested in. Exxon was a place investors had not invested in for years. Mm-hmm. But as they started uncovering and peeling back the onion on Exxon, they realized, energy is going to be here for a long time. Energy is really important. Oil prices are probably going to be more stable now. Exxon generates a lot of free cash flow. It's going to actually grow its production. It's going to grow its free cash flow. It's going to increase its dividend, continue to buy back stock. And so I think investors decided a little rotation has been going on for a little while, and we think it can continue with mega cap tech being sold and energy stocks like Exxon being bought.
Anyway, speaking with Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Still ahead, we'll take one last look at today's market movers before we go. Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Mode Financial. Send us your questions to knowyouroptions at bnnbloomberg.ca. And let's take a last look at the markets before we head out for today. Start with the North American markets. And a lot of red going on right now. The NASDAQ down there. You can see the TSX up by 0.7 now. It's dropping. S&P 500 off by 0.32, NASDAQ by 0.17. Looking at oil right now, let's see where we're at. It has been a roller coaster, continues to be a roller coaster. It's back up today, more than 5% at 87, almost 88 right now. And the metals, how are we doing with gold? All in the red. It is an interesting time right now. Gold's up by 1.3, silver 4.86, copper about 1.25. And a couple of, I'm going to try and get to a couple here. Ballard Power is up right now, one of the movers right now quickly. It's up more than 7% on an agreement to provide 500 fuel cell engines to NFI. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have a great day.